Welcome back to Kiwoon. My name is Caleb, and today we'll be going over Google. Last week we heard some crazy news about Google stock doing a 20-to-1 split, and in this video we'll be going over what the split means and why Google may be joining the Dow Jones. Remember, if you guys are liking the content, make sure you go and hit that like and subscribe button down below. Now let's get right into it. So what happened last week? After Google crushed their earnings last week, we heard some insane news that the Google is doing a 20-to-1 stock split around July 15th of this year. Now, if you guys didn't know, a stock split, simply put, is essentially when the shares in the market increases but doesn't actually do anything to the stock. Now hear me out, CNBC essentially does an example for us here, and I know it's kind of confusing, but when a company whose shares cost around $1,000 a piece, if they underwent a 2-for-1 stock split, the overall amount of shares would double, while the price of each share would drop to $500. An investor who owns 100 shares in this fictional company will still have around $100,000 worth of stock, but it would now own 200 shares instead of the 100 previously owned. Again, put simply, a stock split is when the company divides up its shares to lower the price and increase the overall amount of shares available. So then we get to the question of why did Google split its stock? At nearly $3,000 per share, Alphabet or Google has one of the pricey stocks in Silicon Valley. The company's chief financial officer, Ruth Perret, she said that she wanted to have more people invest into the actual company, so this was the reason why they would split down to roughly $150 at today's market share. But in my opinion, the underlying reason why Google would do this is so that they can join the Dow Jones. See, the Dow Jones is one of the most highest viewed indexes, and it's actually the top 30 companies in the US, and it shows financial media's most are referenced in the US market. And it generally is a good indicator of the overall markets and how they're playing out. I think this is honestly just an amazing play by Google's marketing team as to keep the increasing reach, as well as to show that they are one of the most influential companies in the US. People may ask why Google may have not been able to join before, and the main reason for this is that Dow is based on weightings. What this essentially means is that stock price changes how much of the Dow holds of that stock. See, Dow is an index, so it holds multiple different stocks, and as I stated before, holds around 30 different stocks. And in this case for United Health Group, the stock price is roughly 480 and their weight 9.1, or meaning 9.1% of the entire index. Now if we scroll down here, we have companies like Intel, all the way at the bottom. Their share is only $48 a share, and they are only 0.9% of the overall index. So the Dow wouldn't want a stock that's currently trading at $2,800 a share, because it would be taking up over 20% of the index. But after Google stock splits, their stock would be around $150, and in my opinion, a good price to join the Dow in, coming around the top 20 in terms of weightings and where they would be placed. Another fundamental reasoning why I believe Google may join the Dow Jones is because they want to actually have a fundamental reasoning behind it. And this doesn't really make sense. Although their financial advisors said they want to make it more accessible, their institutional or insider ownership is above 65%. And this essentially just means that 65% of the total stock is owned by hedge funds or institutions. These are people who have millions, if not billions of dollars, and it doesn't really matter to them what the price of Google is. But yeah, these are just a few reasons why I believe Google is splitting at this point in time, but now onto some quick fundamentals. As we can see by this price to sales model given by Finbox, we see here that right now, Google has roughly a minus 7.8% upside, and giving them a fair value around $2,600 a share. And in my opinion, Google is slightly even more overvalued, and my honest price for them is around $2,400. Again, Google is a stock that I would love to put on my watch list, but after this huge jump that they just had off of the news and of earnings, I just don't like their stock at its current value. See, the thing about Google is having to differentiate between what is fair value and what isn't. A lot of people will tell you Google is a buy any day of the week, but when you actually break down the fundamentals of that company, they are just not actually fair value. See, those same people, if you were to ask them if Google should be worth $10 billion, would probably say no. But honestly, given the valuation that they're at now, this is where their valuation will probably be within the next 10 years. Now, I know a lot of stocks nowadays are trading for multiples and fundamentals way above its fair value, but that's not what we're really trying to push out to you guys. It's about the fundamental understanding of what the company is and what it does, and how to essentially value them from there. I think in terms of trading that Google is quite shaky going up and down until around July 15th, but after the stock splits, we're going to have a huge amount of retail volume coming in. But other than that, guys, I hope you guys have a great rest of your day and hope you guys enjoy the video. Make sure to leave a like and comment down below. And remember, make sure to tell someone that you love them. Peace.